Welcome to JM Financial Mutual Funds Equity Outlook. In this short video, we would take a look at how different economic and market factors behaved in the recent past. We would also look at our view on the Indian equity markets, which may in turn impact the positioning of our schemes. The Nifty index was up 1.2% for the month ended February 2024, the Nifty Midcap 150 index and Nifty Small Cap 250 index underperformed the large cap indices and were down by 0.3% and 0.7% respectively. Sector-wise, Nifty PSU Banks 10.5%, Nifty Realty 6.3%, and Nifty Auto 6.2% were the top performing indices, whereas Nifty Media minus 4.7%, Nifty Private Bank minus 2.1%, and Nifty FMCG minus 1.9% were the laggards. Global indices ended the month of February 2024. On a positive note, Dow Jones and Nasdaq were up by 2.2% and 6.1% respectively. And the Financial Times Stock Exchange, FTSE 100, ended on a flat note. The India Volatility Index, or the India VIX, saw a decline in February 2024. It was at 15.57 compared to 16.05 in the previous month, down by 3%. The Chicago Board Options Exchange, CBOE, VIX, saw a decline in the month of February 2024 and was at 13.4 as against 14.35 in January 2024, down by 6.6%. Foreign Institutional Investor, FII, were net seller for the month of February 2024. Net FII outflows were Rs 201 crores. Domestic Institutional Investors, DII, bought stocks worth Rs 25,379 crores, whereas MFs were net buyers worth Rs 16,439 crores. Nifty PE is now trading greater than one standard deviation above the mean PE. However, it is still 10% below its peak. Nifty Midcap 100 PE is trading greater than one standard deviation above the mean PE. However, it is still 19.2% below its peak. February was a busy month for our equity team as we interacted with nearly 100 corporates and attended several investor conferences. We present some of our findings as also what are the potential drivers of the Indian equity markets from here on. India is definitely on the path of investments. Almost all companies agreed that capex is increasing and that the government's policy of crowding in investments is working. Some companies were still cautious on the overall outlook, but the majority were optimistic on the future. We spoke to several public sector companies who outlined their capex plans. On the face of it, these capex plans could provide a strong boost to local manufacturing and engineering companies. Some of the major companies seem to be benefiting from significant capex in Saudi Arabia. Defense expenditure is being domestically sourced, which has led to record order books. Green energy is a long-term trend. India's lack of oil and gas may make green energy more relevant. Solar and wind energy could be the primary drivers towards India's decarbonization goal, but other areas such as green hydrogen, green ammonia, nuclear, pumped hydro and ethanol from agri-waste are many of the options being explored. While government intent is clear, policies are still work in progress as many incentives and taxation issues need to be resolved. This is unlikely to happen before the elections and hence could be delayed. The overall conclusion on solar and wind energy and its benefits came out strong and clear. Electric vehicles was another theme, which was tossed around, and all oil marketing companies, OMCs, pledged to have electric vehicle charging stations as also conventional charging stations. Electric vehicle infrastructure build-out in India has been slower than anticipated, but there are signs that it is gaining pace. Batteries will take time to stabilize and produce in India economically, but some of the ancillary chemicals and infrastructure could benefit. China is still a formidable supplier. China's manufacturing expertise and scale are difficult to replicate. China dominates many verticals and horizontals in manufacturing, and trying to repeat this will be difficult for India. There are several product gaps in domestic manufacturing, especially chemicals, which is leading to inefficiencies across. This can prove to be both a threat and opportunity. India will need to subsidize domestic manufacturing by way of production-linked incentives, PLI, or prevent irrational imports. China's slowdown could create bouts of surplus capacity and cracks in pricing power from time to time. This is creating volatility in earnings for Indian companies, further compounded by destocking in sectors such as pharma intermediates, steel, agrochemicals. While India may be the obvious choice to us as domestic investors, lack of infrastructure and backward integration may be deterring factors to the Make in India theme. Manufacturing is becoming more localized. Although China is the most competitive supplier, many countries such as India and USA want to have a domestic base to manufacture their own goods. America is subsidizing its companies through its Inflation Reduction Act, IRA, while India is trying to boost manufacturing through its PLI. Our concerns are that India may not be able to get large-scale manufacturing as USA is throwing big money to capture high-technology manufacturing and bear higher wage inflation. What about domestic consumption? Time to offer variety. One of the large FMCG companies highlighted that FMCG growth rates tend to slow down as per capita incomes and product penetration increases. The recent tepid performance of consumer companies may be an indication of increased competition and high penetration across certain categories. Large companies may face an issue of offering differentiated products than smaller companies. Consumer durables and auto purchasing has become easier with availability of finance through Buy Now Pay Later, BNPL. Banking and finance. Technology is a disruptor. Some of the meetings that our fund managers and analysts attended highlighted the benefits of account aggregator data availability. This could lead to a level playing field between all banks to access client information. This may increase competition among banks and reduce profitability, while allowing the size of the market to expand. A large number of institutions are chasing unsecured credit to enhance spreads, which is worrying. Corporate credit is still weak, but we anticipate a surge in borrowings as corporate capex gets implemented. The U.S. Federal Reserve and India's Reserve Bank left keys rates unchanged, indicating that inflation is still a worry for them. However, there has been a slowdown and inflation has cooled off considerably. We now risk being overcautious, disturbing the growth momentum that is required to create employment to millions. Eurozone Purchasing Managers Index was most impacted but seems to be slowly recovering. Manufacturing companies from India exporting to Europe indicate that the worst is behind them. China and US are close to critical levels and any further slowdown may impact growth substantially. Services PMI has been more resilient than manufacturing, and both China and USA are showing an improving trend. Equity markets continue to move up globally. Is it an assumption that interest rates will eventually decline, or is it an expectation of continued robust corporate performance? Indian equity markets continue to rally with small caps leading mid caps and large caps. Market volatility has increased as also sector rotation, implying a flexible investment approach may be required. While valuations are high, growth prospects remain bright. Apart from cost of capital and higher yields from fixed income assets due to increased borrowings, we do not see reasons for a rapid fall. Q3 FY 2024 corporate earnings exhibited a lower growth than the previous quarters. It is expected that the earnings momentum to decline as higher interest expense and depreciation begin may impact reported profits. It is expected that the operating cash flows may remain healthy, but free cash flows too decline as companies begin their investment cycle. During this phase, we could expect some equity dilution as most companies indicated an aversion to debt, and a robust IPO pipeline can also impact market performance. The stock performance last year has been on back of growth expectations in infrastructure and real estate. We see some green shoots in pharma and technology sectors. Apart from these, we continue to have faith in domestic manufacturing, infrastructure, renewables, and EV transition. We will be entering into election mode shortly, and there could be some volatility. Skirmishes and wars are disrupting trade and creating temporary bottlenecks and shortages. The U.S. economy is slowing down, though capex is growing strongly. Central banks in India and the US will have to be cautious so as to not break the growth momentum. We are in a multi-year cycle of investment and capacity enhancement coming after a sustained period of fiscal correction. There may be periods of slowdown, but the long-term trajectory is intact. Market valuations may remain high, but volatility is definitely on the rise, indicating that a balanced asset allocation is preferable.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.